Welcome to JM Financial Mutual Fund's Fixed Income Outlook. In this short video, we would take a look at how different global and domestic factors behaved during the month gone by. We will also share our views on the domestic fixed income markets, which could in turn impact the positioning of our schemes. Global yields increased during the month of May 2025. 10-year Treasury bonds, 10-year Japan bonds and 10-year German bond rose by 24 basis points, 18 BPs and 6 BPs respectively. On the tariff front, some clarity has emerged during the month, however. Business optimism and consumer sentiment remains weak. While fiscal pressures and fears of inflation have taken precedence during the month, deteriorating global growth outlook remains on the horizon. U.S. 10-year benchmark yield rose to 4.60% intra-month due to several factors: fiscal pressure, triggered by the tax cuts mentioned in the tax bill, weak auctions for long-dated securities, increasing inflation fears, and cross-border selling. The latest report from the U.S. Department of Treasury as of March 2025 shows that UK has overtaken China as the world's second-largest holder of U.S. Treasuries. Purchasing Managers' Index and consumer sentiment weakened further in May, with Composite Purchasing Managers' Index falling to 50.6 April 2025 from 53.5 March 2025. On a quarter-on-quarter basis, GDP shrunk by 0.2% in Q1 calendar year 2025 versus a growth of 2.4% in Q4 calendar year 2024. On the inflation front, Consumer Price Index slowed to 2.3%, lower than expectations and March 2025 print, while expectations of inflation have remained elevated. The Michigan one-year inflation expectations in May 2025 increased to 6.6% from 6.5% in April 2025, and the Michigan five-year inflation expectations in May 2025 remained elevated at 4.2%. from 4.4% in April 2025. University of Michigan surveys consumers and presents the median expected price changes for the next 1/5 years. The result of the one-year inflation expectation remains the highest inflation expectation since December 1981. Japan. 30-year and 40-year Japan government bonds yields hit record peaks at 3.185% and 3.675% respectively, while the 20-year yield hit a multi-decade high of 2.60% in May 2025. The increase in yields was a combination of intensifying selling pressure amid growing concerns over debt levels in major developed economies, particularly Japan and US, and subdued demand at the long-term auctions thereof. Bank of Japan Governor Kazuo Ueda mentioned that the central bank will watch whether swings in super-long yields have a knock-on effect for shorter maturities, which have a larger impact on economic activity. Gross domestic product for Q1 calendar year 2025 in Japan contracted by 0.7%. compared to a 2.4% growth in Q4 calendar year 2024, while consumer price index inflation remained elevated at 3.6% for the month of April 2025. We understand Bank of Japan may maintain its policy rate at 0.5% for this quarter before resuming its course for further rate hikes. The 10-year GSEC traded in a band of 6.24% to 6.40% and closed at 6.28% in May 2025, vis-à-vis 6.36% in April 2025. sovereign yield curve bull steepened further during the month, with short-term yields falling more than the longer-term yields. Systemic liquidity surplus, post the measures by RBI to infuse liquidity such as open market operations and long-term forex swap, rate cut by RBI and the expectations of further rate cuts, on account of slowing growth and cooling inflation in India, have pulled down G-Sec yields. At primary auctions, yields of 91-day T-bill, 182-day T-bill and 364-day T-bill softened sharply by approximately 28 basis points, approximately 30 basis points and approximately 29 BPs respectively, due to the aforementioned reasons. Gross domestic product grew by 7.4% during Q4 fiscal year 2025, which was better than the median estimate of 6.8% as per the Bloomberg poll of economists. The latest headline quarterly GDP figure is an improvement from Q3 fiscal year 2025, led by higher investments and contraction in imports. Higher gross fixed capital formation or investments was largely attributable to an increase in government capex. During Q4 fiscal year 2025, government capex stood at rupees 3.7 lakh crore, which was 35% of the total capex as per revised budget estimate. Private final consumption expenditure, which accounts for about 50 to 55% of gross domestic product, observed a weaker growth of 6.0%, considerably lower than 8.2% in Q3 fiscal year 2025. Consumption demand continues to remain muted, largely because of lower urban demand. Further, imports during the year have witnessed degrowth, shallow growth, indicating slower domestic consumption. Exports growth moderated 3.9% in Q4 fiscal year 2025 from 10.8% in Q3 fiscal year 2025, led by global trade uncertainties. On the supply side, the gross value added GVA grew at 6.8% year-over-year. While it is a slight improvement from the performance in the previous quarter, GVA growth has remained below 7.0% in the last 4 quarters. The agricultural GVA growth moderated in Q4 fiscal year 2025 as compared to its performance in the previous quarter. However, agricultural activity during the year showed an improvement, supported by normal monsoon, healthy kharif and rabi sowing and output. Industrial sector observed an improved growth of 6.5% in Q4 fiscal year 2025, up from 4.9% in Q3 fiscal year 2025. Within industry, construction recorded the highest growth of 10.8%. This could be alluded to the increase in government capex. Despite the improvements in the latest numbers, industrial GVA growth continues to underperform as compared to its last high of 15.1% in Q2 fiscal year 2024. The GVA growth in the services sector continued to be robust at 7.3% in Q4 fiscal year 2025. While the latest quarterly numbers showed some improvement in growth, the annual GDP growth of 6.5% was considerably lower than 9.2% in the previous financial year. Risks to domestic growth remains skewed towards downside, with global macroeconomic headwinds and domestic demand slowdown. The subsequent policy decisions by the RBI MPC may likely to continue to give more importance to support growth as inflation remains benign. CPI inflation remained below 4.0% level at 3.16% in April 2025 compared to 3.34% in March 2025. The reading also came in lower than the Bloomberg's median poll of 3.50%. Food and beverages inflation moderated even further to 2.14% in April 2025 from 2.88% in March 2025, lowest since October 2021. Vegetables noted a further deflation of 10.98% in April 2025 on a year-on-year basis, led by a sharp decline in prices of tomato, garlic, ginger, cauliflower, etc. Along with vegetables, pulses also noted a deflation of 5.23% in April 2025. Core inflation remained flat at 4.10% in April 2025. Inflation scenario has improved in the past few months, aided by a sharp decline in food prices. As inflation is expected to remain closer to the target of 4.0% in fiscal year 2026, it is likely that the RBI would continue with monetary policy easing. During the month, dollar index depreciated by 0.14% as compared to 4.67% in the previous month, as growth concerns linger in the U.S. The evolving trade dynamics and a potential trade war can impact U.S. growth adversely. Though the pace of the dollar depreciation has slowed down due to reduced uncertainties from U.S. tariffs, there are stronger downside risks due to the possible increase in fiscal deficit owing to the recent tax cuts proposed by the current U.S. administration in the One Big Beautiful Bill. The Indian rupee witnessed a depreciation of 1.29% in May 2025. The currency traded in the range of rupees 84.25 to 86.01 per US dollar during the month and ended the month at rupees 85.58 per US dollar. In terms of the 40 currency real effective exchange rate, REER, Indian rupee continues to be overvalued above 100, however, has come significantly down from the recent high. Also, in May 2025, Indian rupee on a REER basis dropped to 100.8, lower than the 10-year average of 103.5. Foreign portfolio investments were net buyers in both equity and debt markets in May 2025, with an inflow of US $2.3 billion and US $1.4 billion respectively. Forex reserves, after making a low in January 2025, have observed continued increase, partially owing to RBI's US dollar per Indian rupee buy-sell swap. Month till date, till May 23, 2025, Forex reserves increased by US $4.6 billion and stood at US $692.7 billion. Liquidity conditions during May 2025 remained favorable, largely aided by RBI's open market operations purchases. RBI infused liquidity to the tune of approximately rupees 1.19 lakh crore through open market operations purchases in May 2025. The banking system noted a daily average surplus of rupees 1.71 lakh crore in May 2025, compared to a daily average surplus of rupees 1.4 crore in April 2025. Going forward, liquidity conditions could remain comfortable, aided by RBI's easy monetary policy and continued liquidity supportive measures. The European Central Bank is expected to announce its 7th consecutive interest rate cut by 25 basis points in the first week of June. This rate cut comes amidst concerns of the sluggish growth exacerbated by the tariffs placed by the U.S. that outweighs the inflation worries. The tax cuts proposed in the U.S. tax bill is estimated to add approximately $3.1 trillion to the U.S. debt. This will add to the fiscal pressure that the U.S. is currently facing, witnessed by the rising Treasury yields. As mentioned earlier, growing concerns over elevated debt levels in major developed economies, particularly Japan and US, has taken precedence over growth concerns. Further, on the inflation front, inflation in the US, though receding, remains above the Fed target, and tariff concerns pose further risks. Given the situation, Fed's policy response will be closely watched. Broadly, markets now expect only 2 Fed rate cuts in calendar year 2025, with Fed expected to keep policy rates unchanged in June 2025. Business sentiment and consumer confidence has been faltering. However, its impact on growth may be seen with a lag by a few quarters. Fed may have to cut rates towards the end of the year. In case the effects of tariffs cause sharp deterioration in growth, or if labor markets materially weaken. China's continuing sluggish economy has support both from monetary and fiscal side to get its economy back on track. The resultant impact on commodity cycle upturn may be a development to be watchful of, especially for import-dependent nations like India. While some clarity has emerged regarding the US tariffs on China, its impact on the global economy needs to be monitored. Japan, on the other hand, is on a rate hike journey, and the continuing unwinding of yen carry trades have affected yields adversely. Given the growth focus by both the government, fiscal support through income tax cuts, and Monetary Policy Committee, monetary support continued with another repo rate cut of 25 basis points. A dovish Monetary Policy Committee policy meeting in April 2025, a further rate cut of at least 50 basis points is widely expected in 2025. Further, CPI moderated to 3.16%, aided by a decline in food prices. RBI has also shown consistent support to the economy through ample liquidity measures, resulting in systemic liquidity surplus in the month of May 2025. Such support from RBI is expected to continue to increase monetary transmission of rate cuts. Factors that bode well for the domestic bond market include inflation being in line with the target, growth which is resilient though moderating, and growing expectations of further rate cuts. Thus, we maintain a bullish bias on the sovereign yield curve and the corporate bond curve and expect the domestic yields to move lower. Further, it is important to note that the corporate bond curve that was inverted in March 2025 has now normalized during the month of May 2025.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.